Welcome to the Investing Show, where we discuss the news that matters to investors and ideas to help you make more of your money. Coming up later on the show, we've got Chris White, manager of the Premier Income Fund, to talk to us about hunting for dividends away from the FTSE 100 usual suspects. I'm Simon Lambert, and here with me in the studio I've got Richard Hunter, Head of Equities at Hargreaves Lansdown,
Right.
and Nick Batsford, CEO of Tip TV. We've also got our Money Tip of the Week coming up later on, which is to do with the best value mortgage that you might not know about. But first, a quick look at some of the stuff in the news that's caught our eyes. Richard, I think you were going to talk to us today about what moves markets, weren't you?
Yes, obviously a very simple topic. On any given day, of course, the market is moving. It's certainly more volatile than it used to be, and there's there's a lot of external factors, exogenous factors, as they call them, which may move the market as a whole. But I thought what it might be a bit more interested to do is go back to basics and look at some of the factors which influence individual share prices, as well as the market as a whole. So, for example, if you take an individual company, it has been said that a lot of analysts who are covering the stock are simply taking last year's movement and adding just a bit on, just extrapolating slightly, which can mean that they're missing the inflection points when something significant has changed in the market. And this is one of the reasons that companies update the market 4 times a year, so that things, in theory, come as rather less of a surprise. So in terms of something the company can't necessarily control, you can get an analyst or a stockbroker who is brokered to the company. As Nick will remember, what you might call the shop. But at any given time, and especially for the larger stocks, there will be a whole host of primary analysts covering that stock as well. It's not unusual for there to be 25 or 30. That's one of the reasons we often refer to the market consensus rather than any individual broker recommendation. And if you get a broker upgrade, even in FTSE 100 stocks, it will move the share price in one direction or the other, depending on whether it's an upgrade or a downgrade, of course. So that's not something immediately that's down to the company.
And as an investor, an individual investor, you want to try and get in ahead of that, spot what they're going to spot, I guess.
Sure, and that's one of the reasons that you take a longer-term view, because those inflection points are particularly difficult to notice. And of course, what can catch the market out is that the company comes out and says, well, actually, our profits that we previously guided are going to be rather lower, a profits warning than expected. The market and analysts weren't expecting that, and the share price is immediately falling out of bed. So it can be down to the company itself, and it can be down to other people looking at the company. Similarly, on the plus side, rather than a profits warning, you might say have a company which has said, well, we've been approached by company ABC and we're in talks which may or may not lead to a full takeover, and obviously on the basis of that bid approach, the shares are going to be marked sharply higher. So in terms of the company itself, that's one of the obvious things that might move a share price. The next thing that could probably move a share price depends on what sector the company is in. For example, quite apart from the fact, if, for example, we had a high-profile assassination, geopolitical tension, or even the outbreak of war, the chances are that the entire market will be marked down initially, whilst people could start to come to terms with what the impact would be. But even so, in the meantime, there would be a number of sectors which would be hit. For example, some of the oil sector might be hit depending on where the trouble had actually broken out. The airline and travel stocks would also be hit, because who wants to travel to that particular region, or indeed get on an aeroplane and that kind of thing. So that's a sort of slightly sector-specific thing that might move a share price. That's not, for example, that geopolitical tension is not necessarily going to have a direct impact on the banks, for example. What it could impact on is gold, which is seen as the ultimate haven in times of global trouble, which in turn could actually be quite positive, for the mining stocks, for example. And then things will start to settle down as the actual ramifications can become known. Now, obviously, there are many, many things which could move share prices, and we can't cover them all today, but I'm just trying to pick out some of the most obvious ones. For example, if you've got regulators fixing prices, or indeed a price war in that particular area of business where you operate, you can find that the share price moves negatively, and that's roughly where we are in the supermarket sector at the moment. You've got downward pressure on food prices, plus the fact that already thin wafer-thin margins are continuing to be squeezed.
And the energy firms saw that as well, didn't they? And also with the oil price fall, we've seen the big oil companies. And we finally got deflation, didn't we? Which
We've got,
you wanted to
yes,
talk
let's talk deflation. So this is picking up from an article in the FT recently. There's just a few sort of bits and pieces I wanted to sort of highlight. So lots of economists at the moment, are telling us that we should not worry about negative inflation, i.e. deflation. The CPI number came in at minus 0.1%. The important thing about that means that prices are falling. Now, how many countries in the Eurozone, have currently got deflation?
That is a good question. I didn't know we were going to be doing a quiz today.
Okay.
But I know that we keep saying we've got good deflation and they've got bad deflation.
We're going to come on to that. But how many Euro countries?
Around 14.
That'll be the correct answer because you looked at my homework earlier.
I was going to say 5. I'm glad I didn't
right.
answer. I made a mistake by just answering now.
So we've got 14 Euro countries have got deflation, including Ireland, Italy, Spain, Switzerland. So again, that's worrying for me. Bout of deflation here for a while. Temporary blip, the economists are saying, So Ben Bernanke used to run the Federal Reserve, said it was deflation, not inflation, that keeps central bankers awake at night. Because they know how to fix inflation, they hike up interest rates, takes basically the inflation away. But they've got no idea, really, how to solve a problem, deflation. In terms of Japan, deflationary scenario, they lasted for 14 years. So this was bad deflation where the prices fall as a result of slowing demand. Consumers expect goods to become cheaper in the future, so therefore they postpone the purchases, worsening the slump. Now, a rosier scenario, if you look back on your history books, fall in prices as a result of better productivity. This was what happened in basically Germany in 1986 when consumer prices fell but output grew. So of these two scenarios, what's the answer? Well, the economists at the moment are suggesting it's far more like the late 1980s than the 1930s. We've got to remember inflation is driven down by the cost of energy and oil prices have been rallying in recent months. In conclusion, if an economy falls into outright deflation, a persistent and generalised fall in prices is very difficult to climb out of. In the conclusion, the central banks need to prevent deflation becoming firmly entrenched because deflation is very bad for equity markets. The central banks at this point must be watching prices like hawks.
I think they're probably watching them more closely than they let on. I think there's been this whole, no, this is good deflation kind of thing. Enjoy it while it lasts is Mark Carney's line. But I think it probably does keep them awake at night a little bit more than they let on.
You've also got different countries measuring it differently, of course. In the States, for example, their main measure of inflation or deflation excludes food and energy prices. It's called the Cold and Hungry Index, somewhat sceptically, because it's actually not an overall, or it's perceived not to be an overall picture of what households have to pay. And by stripping those two out, they've probably got small inflation, of course, whereas we kind of tend to put the whole basket in, and with that downward pressure on food and energy at the moment, no wonder we're in negative inflation.
That's keeping rates on the floor, which of course leads to one thing: people hunting for yield. And actually, the thing that I was going to flag is that there's a bit of an opportunity at the moment, which is that for much of the last good few years, the investment trusts, income investment trusts, have been trading at a premium, which highlights how desperate people are for dividends. Now, actually, there's been a bit of a turnaround this year with that, and I ran some numbers earlier in the week, and all but 5 of the 26 investment trusts in the AIC's UK equity income sector can actually be bought for less than the value of the assets they hold. They're now trading at a discount. And with an investment trust, because it's something called a closed-ended investment, there's a limited number of shares, they're traded on the stock market, so the price can be different to what's called the net asset value, which is the value of the things that it holds. Now, I've got a slide here which shows 5 big-name trusts which have fallen onto a discount. And you can see here you've got the name of the trust, you've got the discount, and then you've got the 12-month average discount. And that's what's important, because with investment trusts, they some of them just perennially trade at a discount. So just saying, oh, well, that's priced lower than its assets doesn't make it a bargain. It's more to do with how that relates to how it's been in the past, what that average discount is. And actually, all 5 of these are trading below their average discount. Temple Bar, Edinburgh Investments, Lowland, Standard Life Equity Income and Murray Income. And these are big name income trusts. And that's not to say that these are necessarily run out and buy them, but it is to say that there's a bit of an opportunity there. Sentiment's turned a little bit on them. There's suggestions of uncertainty around the election, potentially a fall in the oil price and some of those big dividend shares, people shying away from them, and also the amount of money going into pensioner bonds as well. So could be an opportunity there.
Yeah, it's very interesting, and of course there's been an ongoing kind of debate, hasn't there, between investment trusts, as you say, open-ended, and what were unit trusts, more widely known as mutual funds these days. But very similar principle in terms of what they're trying to achieve, but very different investment vehicles.
Yeah, I think it's one of those things where people have to be have to think about both sides of it. It's like it's not just black or white. It's not, they don't have to be polar opposites. It's like with passive investing. You don't have to just buy an active fund or just a passive fund. You can mix the two up.
Mix and match, yeah, absolutely.
So, coming up soon, we've got Chris White to talk to us about hunting for dividends away from the FTSE 100 big boys. But first, our money tip of the week. Now, this money tip of the week is to do with the best value mortgage that you might not know about. Everybody thinks in terms of 2 and 5 year fixed rate mortgages normally, and 5 year fixed rate mortgages have been extremely popular recently because rates have come down a very long way. But actually, figures show it's 4 year fixed rate mortgages that have fallen by the most. The best 5 year fixed rate mortgage you can get at the moment is at 2.14%. The best 4 year fix you can get at the moment is at 1.84%. Now, there's an obvious problem here in that you're fixing your mortgage for one less year. So you do need to consider that. But it highlights why it's sometimes worth looking away from what all the headlines are about. So if you are looking for a mortgage, consider a 4 year fix. That's the money tip of the week. And coming up after the break, we've got Chris White. Welcome back to the Investing Show. Joining us in the studio here, we've got Chris White, manager of the Premier Asset Management Income Fund. Chris is here to talk to us today about hunting for dividends away from the FTSE 100 big boys and also where he sees some opportunities right now. While we had the break, we were talking about mortgages and Chris asked me, where do you get those mortgages from? So I should have said, if you go to thisismoney.co.uk/mortgages, then you'll find a full list of all those top mortgage rates. So you can get yourself there if you're looking for one, Chris.
Absolutely.
Chris, tell us, income. I mean, it's hugely popular with investors. But why should investors look at an income fund?
Equity income investing has been a fabulous way of achieving returns over a long period of time. It's that combination of capital growth, income, and income growth, which is very powerful. These compounding returns are very attractive for investors. And actually, if you look at the performance of the average equity income fund against the average growth fund, it tends to perform better over long periods of time and with low volatility. And when the reason for that, I think, is, when you're actually looking for companies, what you're actually looking for is companies that are paying good dividends. And those companies that are paying good, reliable, growing dividends tend to have very strong cash flow. And if you're investing in companies with strong cash flow, they tend to be pretty good quality companies, and that quality comes through over long periods of time and provides extremely attractive returns for investors. And it's actually interesting that a lot of people who are actually after capital growth like the disciplines of the equity income approach rather than going for a growth approach per se.
So you're also the head of equities at Premier Asset Management. Now, something I think that's really interesting for our viewers is, how does a fund manager do that bit of work? So how do you like to look for shares?
You can get your ideas from all sorts of different places. You can be reading the newspapers, reading investment magazines, looking on websites, talking to company management, seeing analysts in the city, just thinking about maybe sectors that are going to do well in a certain type of environment. And all those things could provide the seed of an idea. But quite often, if you're searching for new ideas, you might actually just screen the market for certain things. So we have systems like Bloomberg where we can just log on and try and search for companies which have big dividend yields, good dividend cover, low valuations that are growing and have little debt. And I think those sorts of things are a good starting point when you're trying to find the seed of an idea of something to explore a little bit further.
So, I mean, for an individual investor who often get their ideas, like you say, from a newspaper or a magazine or walking down the street, that's what they need to be doing next, is going and looking into those fundamentals of those companies.
I think so, because I think the nice thing about equity income, the equity income approach, is you're trying to buy things on cheap valuations, trying to buy things when they're lowly valued and on high dividend yields. And it's that entry point which provides you with a good opportunity to make long-term returns. So I think that once you've found your idea, then have a few sort of valuation disciplines that you stick to, perhaps looking at companies that yield over 4%, that have dividend cover of over 1.5 times, that have a low price earnings ratio of maybe 12 times if you can find them at the moment. Not the easiest task. And companies which have low debt, because debt can be very troublesome. I think we saw during the credit crunch that there were companies that entered the credit crunch with balance sheets which were too weak, that is to say debt which is too high. And these companies were forced to either cut the dividends or issue equity, and that ended up being very dilutive for shareholders. So I think some of those disciplines are very helpful, just trying to avoid mistakes, basically.
And it's also the dividend cover metric, for example, sorts a lot of the wheat from the chaff, doesn't it?
Absolutely, because
if it's too low.
Yeah. One of the dangers for investors is you buy a company which has a big dividend and that dividend gets cut, because all of a sudden you'll lose quite a lot of capital. So you have to make sure that dividend's actually reliable. So, what is the cash flow that backs up that dividend? Is that cash flow capable of growing over the next few years? And how much is your dividend actually covered by earnings and by cash flow? And if you can satisfy yourself that you're going to avoid a dividend cut if the economy or the company's prospects don't work out to be do quite as well as you expected, then at least that provides you with a safety buffer. And I think that buffer of safety it just helps you avoid making big mistakes.
So the dividend payers in this country are dominated by a handful of big names, aren't they? I mean, you look at the statistics, that top 5 really does dominate it. Yeah. You like to look away from those big FTSE 100 companies, do you?
I think at the moment a lot of the opportunities are actually in the small and mid-cap area. There are still 1 or 2 large caps which are offering a lot of value. The likes of, I think, Royal Dutch Shell look interesting, HSBC and Imperial Tobacco. But I think a lot of the real opportunities are further down the market cap scale. I think markets have had a good run and in certain areas look quite toppy. So I think you have to ferret around a little bit more to try and find your ideas. And it's easier to do that perhaps in the small and mid caps than it is in the large caps at the moment.
Is there any sectors or shares that you particularly like at the moment?
If I was to give you an example of perhaps of a large cap company, a mid cap company and a small cap company that we currently think are interesting, Imperial Tobacco would be a topical stock, because today they've just managed to complete an acquisition in the US. You've had a merger between Reynolds American and Lorillard, 2 big tobacco companies, and Imperial Tobacco has acted as a white knight and taken over a portfolio of brands that have come out of that merger. Yep. And what's good about that is that Imperial Tobacco it has a 4.5% dividend yield, and this acquisition will help them grow the dividend at 10% for the next 3 years. So if you think about that, then you've got a dividend of 4.5% this year, 4.9% next year, 5.5% the year after that, and probably 6% the year after that. So actually, if you've got that sort of dividend growth, that's really attractive against inflation and interest rates and other sorts of assets you can own. But if you've got that sort of income and that sort of growth, then the capital is going to work for you as well over the long term. So I think that's a really good opportunity for equity income investors at the moment, and a stock that should perform reasonably well over the next few years, and actually is not a very cyclical company. So if the economy happens to turn down, I think you still should be able to get reasonable profits growth out of the business.
What about further down the scale? You said about mid-cap as well.
Further down the scale, well, I've just come out of a meeting with a company that I own in my fund called Crest, and I met the management of the business. It's a company that's on a pretty low valuation and has a dividend yield of around about 5%. And there's 2 sides to Crest. It has a dairy business and it has a branded food business, which includes brands like Cathedral City and David Stowe and Clover, some spreads business. At the moment, it's trying to sell its dairy business to Muller, and it needs to go through the Competition and Markets Authority. But if it succeeds in getting the clearance for that acquisition, then it leaves Dairy Crest as wholly focused on branded foods. Cathedral City is a tremendous brand. It's the number 16 brand in the FMCG category, and it's growing faster than most of those top 50. It's a tremendous job they've done with developing the brand in the UK. And it's if they can demerge the dairy business, then it leaves investors just owning a branded foods business, which looks extremely cheap compared to other FMCG businesses at the moment. So I think that's a really interesting opportunity. And if I was to look perhaps further down the market cap scale, another company that we own on our fund is a stock called Conviviality Retail. It came to the market via an IPO 2 years ago on an 8% dividend yield.
The owner of Bargain Booze, isn't it?
The owner of Bargain Booze, absolutely right. So they came to the market on 8% dividend yield with a low valuation, with no debt, and 600 franchised Bargain Booze stores around the country, mainly in the North and the Midlands, but with some elsewhere. And the shares have done well. They're currently trading at about 140, but they still yield 5.7%, and that dividend's still well covered by profits, which are about 1.7 times. It still has no debt. And I think that that, to me, sort of gets me interested in the fundamentals of the business. What else gives me comfort about a stock like Conviviality Retail is that they recently made an acquisition of a company called GT News, which is a chain of about 30 or 40 convenience stores in the north of England. And they were all franchised out to one franchisee who is extremely well known within the industry. And to get that sort of third-party endorsement for your business model is actually something that can give an investor like myself a great deal of comfort.
Mm-hmm. Mm-hmm. I mean, small caps, they're much less researched, aren't they? It's a right ground for people to hunt.
This sounds as if this should be in my portfolio from what you just said. So that sounds extraordinary.
I think, you're absolutely right. I mean, there's sometimes only one or two brokers that cover some of these small companies. Yeah. So if you're prepared to have people in your team go out and research them yourself and maybe go and visit the company, then it can be, you can find some terrific ideas. It can be a real goldmine.
Excellent. Well, Chris, thank you very much. Thanks for those ideas. Richard, thank you. Nick, thank you. Join us next time on The Investing Show. Goodbye.